Hi there. Have you been told that you make too much money and therefore don't qualify to contribute directly to a Roth IRA? Or have you been told that you make too much money and because you are part of a workplace retirement plan or your spouse is, like a 401k, that you can't contribute to a traditional IRA? Well, I'm here to share with you how you can still potentially contribute to a Roth IRA through what is known as a backdoor Roth contribution. Now, this is not a legal term. You're not going to find this in Publication 590 or the Internal Revenue Code. This is an industry technique that says that you can contribute to a traditional IRA and then immediately convert over to a Roth IRA. Now, prior to 2010, you couldn't do this because there were income restrictions on Roth conversions, but they lifted those limits in 2010, which opens up the backdoor contribution approach. So first, let's talk about how much income is too much to contribute directly to a Roth IRA, and then we'll dive into this ability to contribute first to a traditional and immediately convert over to a Roth, even when you are participating in a workplace 401k or other retirement plan. So first things first, what is modified adjusted gross income? You're going to see this term used a lot in terms of how much you can contribute to a Roth account, or if you are disqualified from contributing to a Roth IRA. Modified adjusted gross income. For some folks, their adjusted gross income, AGI, is identical to their modified adjusted gross income. Modified adjusted gross income is your adjusted gross income, and then you have to add back in certain exclusions from adjusted gross income. If you're not sure, I'd encourage you to check with your CPA or tax accountant, or in other words, whoever is preparing your tax return, to give you a better idea of whether you are near these MAGI limits or if you will be well under these MAGI limits and therefore can make a direct contribution to a Roth IRA. Now, all of this you'll find is in a way irrelevant because the backdoor contribution just simply allows you to contribute to a traditional IRA first and then immediately convert over to a Roth IRA. But it is really important to understand this because if you're under the MAGI limits, then you might as well just make a contribution directly to a Roth IRA. But if you are close to these MAGI restrictions, or you certainly exceed the MAGI restrictions, then you're going to want to contribute first to a traditional IRA and then immediately convert over to a Roth IRA. So what are these income restrictions? Well, first you have to understand that it's going to be dependent on your filing status, whether you are a single filer, married filing jointly, or married filing separately. So first, let's talk about if you are a single filer and you want to contribute to a Roth IRA, if your income is under $129,000, and that would be modified adjusted gross income, then you can make a full contribution to a Roth IRA. Now, these limits are for 2022. So if you're watching this in the future year, you're just going to make sure you look up on the IRS website, irs.gov, what the current year's MAGI limits are. So in 2022, it starts at $129,000. And yes, these do tend to increase year over year. Now, how much can you contribute to a Roth IRA or traditional IRA in 2022? That would be up to $6,000 when you're under the age of 50 and up to $7,000 when you're 50 and over. And then next year, 2023, you'll be able to contribute up to $6,500 when under 50 and up to $7,500 when you are 50 and over. So if you make under $129,000 as a single filer, you can make your full $6,000 or $7,000 contribution. But then you have what is called the phase out range. So the phase out range is between $129,000 and $144,000. What this means is as you get closer to 144, you can only put a fraction of that full $6,000 or $7,000 contribution into the Roth IRA. And then once you breach $144,000, you are not able to contribute a single dime to a Roth IRA. But just remember, as we go through this training, if you're over these limits or you're in the middle and you want to make a full contribution, you simply contribute first to a traditional IRA and then immediately convert over to a Roth IRA. Prior to 2010, if you made $100,000 or more modified adjusted gross income, you could not convert from a traditional to a Roth account. Weren't allowed to do it. In 2010, the law changed and it wiped out that $100,000 MAGI restriction. And it said all income earners, regardless of how much money they make, they can convert from their traditional to their Roth account, opening up this backdoor approach. All right, what if you are married filing jointly? If you're married filing jointly, the phase out range is going to be between $204,000 and $214,000. Okay, again, this is for tax year 2022. So we're between $204,000 and $214,000. Under 204, you make your full contribution to your Roth. If you're over 214, you can't contribute to the Roth at all. Therefore, you need to go through the backdoor approach. Married filing separately. If you're married filing separately and you make over $10,000, so this is a very small amount. If you make over $10,000, then you can't contribute the full amount to the Roth account. Therefore, you'll need to go through the backdoor approach. All right, so now that you understand these income restrictions and you understand the concept of first contributing to a traditional to a Roth, you might read or you might be told that you have to be cognizant of the Pro-Rata Rule. So what is the Pro-Rata Rule? Well, it's important to understand that this shouldn't be something that would instill fear in one. It's just something you have to understand from an accounting perspective, how to work through the logistics here. So let's describe what the Pro-Rata Rule is. And for you to understand what the Pro-Rata Rule is, you have to understand what is referred to as non-deductible IRA contributions. And this is only going to apply to those of you who are participating in a workplace retirement plan, like a 401k or a thrift savings plan or a 403b. If you aren't participating or part of a workplace retirement plan, and you would also have to look at if your spouse is. So if both you and your spouse are not part of a workplace retirement plan, then you don't have to worry about this. But if you are, you're going to have to be cognizant of how these non-deductible IRA contributions work. So let me pause for a moment. I mentioned at the very beginning that some folks are told that they can't contribute to a traditional IRA because they make too much money and they're part of a workplace retirement plan like a 401k. Well, it's not that you can't contribute to the traditional IRA. It's that when you contribute, your contribution is going to be considered a non-deductible IRA contribution. This came about in 1986 when some legislation was passed at that time. So what is a non-deductible IRA contribution? Well, let's say that you have $100,000 that you had in a 401k that was all tax deferred, and you rolled that 401k over into a traditional IRA. So that's all tax deferred money. You got tax deductions on all that money going into the account. So the traditional IRA grows tax deferred, and then when you take it out, you have to pay taxes. Well, now let's say that you make over a certain amount, and we'll talk about that in just a moment, and you are also participating, or your spouse is participating in a workplace retirement plan like a 401k. Well, the law says that if you are and you're over these limits, that when you make a contribution to the traditional IRA, you're not going to get a tax deduction for it. So let's say you fall into this category and you make a $6,000 contribution. Well, that's okay. You can make a $6,000 contribution to the traditional IRA combined with your rollover amount, but that $6,000 is going to be non-deductible. So you're not going to get a tax deduction for it that year. But eventually, when you pull the money out after the age of 59 and a half, or even prior to 59 and a half, a percentage of your distribution is going to be taxable and a percentage is not going to be taxable. And the reason for that is because a percentage you didn't get a tax deduction for when you put the money in, hence the non-deductible IRA contribution. So let me pause for a moment and give you an example so you can really wrap your head around this. And this goes back to the Pro-Rata Rule. So let's use our scenario. We have $100,000 in a traditional IRA, and we make a $6,000 non-deductible IRA contribution. Now, let's say we grow that account, and then at let's make the assumption that at 59 and a half, we want to take out let's just call it a $10,000 distribution. So we're going to have to do some math here, because 6,000 of the amount that's in the plan is non-deductible. So what we're going to do is we're going to take 6,000 as our numerator, and then our denominator is our balance of 100,000. and that comes out to be 6%. We're just going to use some round figures for this demonstration. So when we take our $10,000 distribution, 6% of that 10,000 is going to not be taxable because of the proportionate amount that was considered a non-deductible IRA contribution. So applying our math here, 6% into $10,000, we're looking at $600. So we have $600 that's not going to be taxable. And then our remaining $9,400 is going to be taxable. Okay, so that's what the pro-rata rule says. We're going to get to where this comes into play with a conversion in just a moment. So now you're probably asking the question, well, wait a second, how much is too much? And remember, it's if you are making a contribution to a traditional IRA and also part of a workplace retirement plan, or your spouse is, like a 401k, 403b, thrift savings plan, so on and so forth. All right, so how much is too much? Well, this is going to depend on whether you are a single filer or if you are a married filing jointly. And it's also going to depend on whether it's you or your spouse that has the workplace retirement plan. So first, let's talk about what if you are single. So if you're a single filer and you make between $68,000 and $78,000. So here again, you have this phase out range. So if you're under 68,000 and you're participating in an employer sponsored plan like a 401k, you'll get a full deduction for your IRA contribution. If you're between 68 to 78, just like the Roth contribution, that's the phase out range, you can only contribute a fraction, or I'm sorry, you can only get a deduction on a fraction of the amount that you contribute. So you can imagine it gets a little bit confusing. What do you think people do that are in the middle? Generally speaking, they just don't contribute. Okay. If you're over $78,000, then in that instance, you're not going to get any tax deduction whatsoever. Now, keep in mind, you can still do this. And for some investors, they still see it to be very economically feasible and financially feasible for them. But some people are told that they can't do it. Remember, it's not that you can't do it. It's just that you don't get a tax deduction for it. All right. So now we move on to what if you are married filing jointly? So if you're married filing jointly, and it's you that has the 401k or employer plan, then the phase out range is $109,000 to $129,000. And again, this is for 2022. So if you're watching this training beyond 2022, you're just going to want to make sure you go to the IRS website, irs.gov, and look up the up-to-date figures. So if you're over 129, you're not going to get a full deduction for your IRA contribution. And then we have, what if we are married filing separately? If we're married filing separately, the amount is $10,000, just like the Roth account that we talked about. And then what if you are married filing jointly, and it's not you that has the 401k or employer plan at work, but it's your spouse? Well, the amounts are a little bit higher. They're actually equal to the Roth contribution amounts that we talked about, or restrictions that we talked about, which is $204,000 to $214,000. Okay, so if you're married filing jointly and it's not you that has the plan, but a spouse, if you're between 204 to 214, you're only going to get a partial deduction for your traditional IRA contribution. If you're over 214, you're not going to get a deduction at all. All right, so where does the pro-rata rule come into play with respect to these backdoor contributions? Well, it's not going to matter if you don't have any traditional IRA, SEP IRA, or simple IRA currently. So let's say you have a 401k and that's it, and then you want to do this backdoor Roth contribution. You won't have to worry about the pro-rata rule because you don't have any traditional IRAs currently, or SEP IRAs or simple IRAs. So you simply just put the money in the traditional and immediately convert over to a Roth IRA. However, if you do have existing traditional IRAs, then a portion, going back to that pro-rata percentages, a portion of the amount you convert will be taxable, and a portion of it if you will, won't be taxable in the sense that you're just taking money going into the traditional after tax and then converting it, of course, after tax. So you're not double taxing yourself. You're just going in with after tax dollars. You're not getting a deduction. You're converting it over to the Roth IRA. By the way, the tax form that you prepare or your CPA would prepare is called an 8606. So that would be included in your tax return. Again, that's called an 8606. So here's how it works. Let's say that you had a traditional IRA with $100,000. We're going to use that same example that we did before. And so this is all tax deferred money, and you want to do this backdoor contribution for this year. So you put $6,000 into a traditional IRA, okay? And then you're going to immediately convert that over to the Roth IRA using this backdoor approach. So what's going to happen is we're going to have to do our math again. So we do our 6,000 divided by our 100,000, which is going to get us 6%. So what's going to happen is 6% goes into the Roth account. The full 6,000 goes into the Roth account, but 6% is going to be treated as the non-deductible contribution that we did for that year. And then we're going to have to pull from this 100,000, if you will, for the remaining 94%. So the remaining 94%, we're going to do 94% times 6,000. And then that amount is going to be added to our ordinary income. And then we have to pay taxes accordingly. So the idea here is that there's some extra accounting work that has to be done. Now, once you dive in, and you're probably going to want to watch this video a couple more times to really fully comprehend it, or maybe have this video with you when you sit down with your CPA or tax accountant so that you guys can work through this process together. All right, so let's just take a little bit deeper dive here and do some math together. All right, so we have our $100,000 traditional IRA. Again, we're making a $6,000 contribution to a traditional, and then we're going to immediately convert over to the Roth IRA. So we're going to have to pull again, if you will, from our balance that we have here. So we have 6,000 going in, 6,000 immediately converting. So we're going to do our math. Okay, we got 6,000, which we're assuming that this is a non-deductible contribution. See, if you're not in that scenario where you are part of a workplace retirement plan, you don't have to worry about any of this. You just contribute to the traditional, right? Convert over to the Roth. So we got 6,000 going in non-deductible. We're going to divide that by our $100,000, which is going to get us 6%. So we're going to take our $6,000 and we're going to multiply that by 6%. So I'd encourage you, while you're watching this video, maybe in a slower speed as we go through this, you are going through the math together. So we got $360. So $360 is going to be treated essentially as that year's non-deductible contribution that gets converted over to the Roth. Then we have the remaining $6,000, which is $5,640. So this $5,640, you're going to want to think of it as it's almost as if we're pulling that $5,640 from this $100,000 to convert it over to the Roth IRA. In other words, $5,640 is going to be added to your ordinary income, and then you're going to pay taxes accordingly on that. Now, for a lot of investors that I've worked with, their goal is to get as much Roth IRA dollars created as possible. So they're willing to pay the tax on that. This would be almost as if you just took money from here and converted it to the Roth and paid the taxes. That is the tradition, in the traditional sense, a Roth conversion from a traditional to a Roth account. All right, so you might need to watch that a few more times to fully understand it. You can also go to irs.gov, and there's more information specifically on this pro-rata rule, or again, check with your CPA or tax accountant. Last but not least, it's important to understand that if you have a 401k that offers a after-tax bucket known as a Roth component, okay, so I'm just going to call it a Roth 401k, but There's no such thing really as a Roth 401k. It's a 401k, and then you have the ability to make after-tax contributions. You'll hear that oftentimes referred to as a Roth component. So if you have the ability to contribute to a Roth account through your workplace 401k, through a savings plan, 403b, there are no MAGI restrictions for those contributions. So regardless of how much money you make, you can make your full contribution to the Roth. The other frequently asked question I get is, can I contribute both to a workplace 401k and also an IRA? And the answer is absolutely. In fact, that's how the laws were designed many, many years ago, going back to 1974, the Employee Retirement Income Securities Act, and then eventually the adoption of the traditional IRA. They were designed to allow people to contribute to both their IRA and their workplace employer plans. All right, I hope you enjoyed this training session on the backdoor Roth contribution, opening up your eyes to the possibilities of what I refer to as compounding interest in the absence of taxation. And then on future training videos and our other training videos, you'll see you can check out youtube.com for those other videos. You'll find lots of content on the different types of alternative investment strategies that equity trust clients utilize with their self-directed IRAs, such as real estate, private placement investments, private equity, hedge fund investments, gold and silver, cryptocurrency, and much more. Until the next training video, keep leveraging compounding interest in the absence of taxation. Thank you.